go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The bear is roaring, and it is a grisly one, I guess. It's big and strong and has got its sort of claws around the market right now. 400 points lower on the Nifty. This is painful. 2% basically on the Nifty gone. And it's not very far behind the damage you're seeing in mid and small camps, which are down 3%, 3% plus. So we're starting closing bell a little earlier, and we'll track everything which is happening, and more importantly, get you lots of opinion, which should be useful as you navigate through these very, very tough times. I'm Prashant. With me, my colleagues Mangalam and Nigel. Guys, good afternoon.
Good afternoon. You know, it's getting painful, right? Over the last 5 months, one thought that maybe now is the time where we would see some sort of bottom here, but that's not happening. It fell slowly, then suddenly in the morning we were talking about how, you know, what started as a pond of red turned into a river, sea, and now as we speak, with the kind of cut that we're seeing, it's an ocean of red.
Well, I would lean to the fact that we're closer to the bottom, but just looking at today's fall, you know, today's fall actually is worrying. The kind of fall that we have seen, and the broader markets in particular, you know, the stocks are just falling. There's no news flow as well. So it appears, you know, I think a couple of elements playing out here. Some of the leveraged players are absolutely getting flushed out, point number one. Point number two, I think an element of tax harvesting is definitely taking place. Yeah. And I think more of the same we are likely to see in the first half of March. And just one more point, you know, in the past we have seen this happen, right? This is seasonally the weakest period between that January to around the early March period. So it seems that as well, that element of that as well is playing out. But I think on the headline index, on the Nifty at around this 21,800 to around 22,000, a lot of technical experts are calling in for some kind of a base out there. And fundamentally as well, things are obviously better placed, but the manner of the fall is something that is worrying to me.
You know, I would be much happier when people stop calling for the bottom. Yeah. That is when the bottom will be typically formed, because it is nothing but sentiment. I mean, you know, people just give up, throw in the towel, and they say, well, they
It appears some part of that is taking place today. You know, the kind of selling.
Hope so. It looks like, I mean, I don't want to use the word, I've not used it so far, capitulation, that much abused word. But this is, I mean, you know, this is, of course, some element of that at least out there, most definitely. So 22,120 on the Nifty, and it's come off very, very sharply. For the week, we are down about 2.5, which essentially means that we had some flat days, more down than up, and of course, a pretty red screen to show for it. Not even going into individual names, sectors, stocks, etc. Market breadth, I think, is slam dunk down. About 11:1 in favor of the number of stocks which are lower. It's easier to spot winners because they're so far and few in between. Let's welcome straight in Pankaj Tibrewal, who's with us. He's founder and CIO at Ikigai Asset Managers. Pankaj, thanks very much for coming on. Very, very red-looking screen. You're, of course, one of the early ones to turn cautious in your earlier avatar at Kotak, I remember. And now, of course, you're managing funds on your own. At what pace are you deploying, Pankaj? Because you turned constructive. You have been turning constructive over the last few weeks. So the pace of deployment, and give us a sense. Yeah.
So Prashant, absolutely you're right. If you look at the screen today for the last month or so, one would believe that there's a black swan event which has happened around the globe or in the country. But on the contrary, we believe that things have started to improve at the ground. And let's look at the market into three parts, because markets are always a Triveni Sangam of fundamentals, flows, and sentiment. And let's address each one of them separately. And please, kind of accommodate some time for me to explain that better. So if you look at from a fundamental perspective from where we were, and our entire cautiousness for the last 12 months was that the market was divorced from the actual reality on the ground. Now, for the last 3 months, actually incrementally things are turning to be positive. The first point is the central bank. The central bank for the last 18-24 months was on a cautious side. to make sure that there isn't overheating. And now the central bank is acknowledging that there is a slowdown, and probably the actions which are following have been very, very good. They did the rate cut for the first time in the last 5 years. You saw the liquidity measures being taken by RBI on a continuous basis. And third, the risk weightage and the relaxations on the risk side, which they have been doing. So clearly, RBI, which was on a monetary tightening side, or a little hawkish, I would say, is turning to be more accommodative and neutral. And that's a very good news from a medium to long term. And they are turning pro-growth. The second one, which led to the slowdown in the economy and markets are taking cognizance for the last 45 days, was the slowdown led by government spending. And happy to state that December saw 170,000 crore of spending by the central government. And as far as our data sets suggest, the high frequency indicators in January and early part of February are also turning out to be incrementally positive. And the government is continuously spending on the capex side. And also, when you speak to cement companies, long product steel companies, wires and cable companies, battery companies, all are saying that post October, November, starting December, things have turned out to be positive. And that's a very, very important sign. The third part is the rural economy, which was under strain for a long period, is turning out to be positive. We had 2 back-to-back monsoons, and clearly that started to show in the commentary of all the companies which have rural presence, that rural is doing better than urban. Now look at the tax rate cuts which have happened. And clearly the tax rate cut, if we went into the budget exactly a month back, saying that there could be a lot negatives in the budget. But if you remember that day of the budget, it was far better than what the expectation was. And clearly the tax cut will start playing its role starting April of 25. So I think when you combine the government actions along with the central bank actions, incrementally it's positive than where we were 12 months back. Now look at the valuation side on the fundamental. Now our excesses, a lot was created over the last 24, 36 months. A large part of that has been taken off. It's like playing a T20 match. 2018-19, we saw that it was a long grind. Now probably cycles have turned out to be shorter and sharper. And last 45 days has taken a lot. We were looking at the 4,600 stock universe, and about 85% of the universe is down by more than 25-30%. And median return of the index is worse than the index return itself. So I think the damage at the stock level has been significant. And on the valuation front, if you take a 12 to 15 months out, I think on a Nifty basis, valuations are below 18 times, assuming just 10-12% earnings growth for the next 2 years. So valuations have aligned itself to long-term averages. So when you look at the fundamental side, I believe that a lot probably is turning out to be incrementally positive rather than negative. Next, look at the sentiment side, Nigel and Prashant. And on the sentiment over the last 15-20 days, we attended various conferences. We met a lot of investors, global, local. The mood out there is extremely negative. Nobody wants to, buy anything. People are just saying, what to sell, what to, do. So sentiment-wise, if that's any contra-indicator, I have never seen in my career such a U-turn in 45, 60 days without any basis on where the global, there's a black swan event. So clearly, I think the valuation reset is happening now. The excess multiples which you all were giving to companies, probably that's getting reset. And earnings growth, in my view, will be much better than what the street is expecting for the next 2-3 quarters. Don't forget that the June and September quarter had a very low base. And optically, the earnings growth will look like double digit as you move into FY26. And even last quarter, if our data set suggests right, I think things are moving in the right direction from a growth perspective. And third quarter, data is out now. The earnings growth was 8.5% for NSE 500 companies on a reported basis. So overall, I think sentiment is extremely poor right now. But when that will again take a U-turn, nobody can call it. But my sense is probably most probably in the next couple of months, market should settle down. But let me give you a caveat that it will not be the same broader market way. Pick any stock, you will make money. I think that era is behind us. And incrementally, I think it will be a bottom-up stock pickers market. And people who can pick right companies, right management, right balance sheet, right cash flow, I think will be the winners over the next 18 to 24 months.
Okay. All right. Hi, Pankaj. Good afternoon. And good to hear those rational thoughts. Pankaj, you know, the economy, the green shoots are there. Earnings will improve. As you said, sentiment is absolutely smashed. You know, and to back up your point on the cement side, I understand that come in the next 2 days in South India, particularly in Andhra Pradesh, is likely to be a 20 rupee price hike, which if demand is not strong enough, will not be digested. So all those factors taken into account. But why are we seeing this sort of selling pressure, right? I mean, we're nearly at around 22,000 odd. What is it? Is it the tax harvesting factor that's playing out here? The valuation reset, yes, that's at play as well, which I think more or less that's got aligned. If you could tell us, you know, how are you reading the situation? If it's going to be tax harvesting, in the next few trading sessions, that will be done and dusted, which will be good news. The FI selling obviously is a problem, but that's not in our hands.
In one single line, Nigel, if you look at the history, in the last 45 years, every calendar year, if you take sensex as a benchmark, there have been only 4 years where markets have seen intermediate correction of less than 10%. So corrections are a part and parcel of any market. However, in the last 3 years, market participants have not seen such a correction and buy on dips made money. So when such corrections happened and a large part of incremental investors have joined the market in the last 3-4 years, it actually played on a sentiment side very badly. And in the first phase, you throw in the towel for every company. Good, bad, there's no discrimination. And I think that is what is playing out, that the structure of the market in the last 4 years have never seen a sharp correction like this. And sentimentally, people are completely taken aback that how it can happen, and they are throwing in their towel. But if you just take an objective view and just take a 18-24 months and a slightly longer call, I think on the hindsight, it will look like a great opportunity. You know, when you are in the correction, it's the most difficult phase. But on the hindsight, every correction for the last 44 years looked as an opportunity. Our sense is that despite of intermediate correction, if you look at the data, 36 out of 45 years, markets ended in positive after that. So yes, this phase was necessary, that investing is simple but not easy. I think everybody has to pay a tuition fee in the markets. New investors probably are learning that way. People who can sustain themselves through a disciplined asset allocation probably will see wealth creation over the next 5-10 years. So I am not on the camp that sell everything and go away. I think what stood for India for the last 5 months back is still true for India. Nothing has changed. I think it's just the excesses which have been taken out. And incrementally, when you move from here, not everything will move. Just keep that in mind.
Right.
I think stock selection will become a very, very important piece for the next 12 to 18, 24 months.
Right. You know, that's a very fair description of things as they are right now, Pankaj. And you spoke about that Triveni Sangam as well. Just to add one more parameter to that, if you could speak on the flows itself, because a large part of the decline has happened because of the, you know, ferocity with which the FIs have been selling in our market. So if you could tell, you know, if there is any data point that we should be monitoring very closely, which may indicate that at some point sentiment from the FII standpoint would bottom out. That's point number one. And secondly, you said that the next 18 to 24 months, when there is recovery, it will not be perhaps every all and sundry stocks which are moving higher. What would be the sectors which have the best bet of growth from here on, if one was looking at the market right now and for opportunities?
So, Mangalam, I think there are 2-3 data points which I would like to share with all of you. The first one is, at some point of time in the next few months, I think FI selling should bottom out. During this conference, I had the opportunity to meet some of the largest FIs on the planet who had come to attend the conference. And their only point was that we come to invest in India for growth. And if growth is not there, probably if we try to look out for other markets. I think if earnings growth starts to come back, which could be in double digits, I think FIs will come back. The second point is look at the data from CY21 till a week back. Domestic investors have poured in $140 billion and FIs have put about $2.5–3 billion. So in the last 4.5 years, FIs have not participated and they are waiting on the sidelines. Nifty from the highs are down by about 16–17% in rupee terms. But don't forget there's a rupee depreciation also. So in dollar terms, we are down by 20–23%. And China and other parts of the world, developed markets, have outperformed India in a massive way. Now, with what is happening in US, and we believe that US markets are at a very, very dangerous zone, and all the parameters we look at are pointing towards a bubble territory out there. If US market starts to unwind itself, we will have some pain in the interim, but over the medium to long term, I think it will be beneficial from a flow perspective. Because whenever you speak to any asset allocator, Mangalam, the answer we used to get that US is 70% of the world index. Let us focus there. India is 4–4.5%. Yes, it will gain priority provided you grow at a much higher pace, but our focus right now at US. If US sees a shakeout, our sense is that FIs will turn back to India from an overall structural perspective. So the point which I am trying to say, it's a cyclical slowdown which we have seen in the economy. That's starting to come back. It's not a structural slowdown, in my view, in my humble opinion. And probably after 12 months, we will think that this 2–3 months, which we saw deep cuts, great opportunities. Mangalam, coming to your sectoral points, we did an exercise 2 days back within the team, and it's a very interesting exercise, which the results were. So we looked at the NSE 500 companies, and we said that how many companies have delivered 10%, we just took as a benchmark, earnings growth of more than 10% for the last 5 years, for the last 3 years, and for the first 9 months of this fiscal. There were about 130 companies which have delivered more than 10% earnings growth out of the NSE 500 over a 5, 3, and a 9-month period. Then we looked at companies which have delivered over a 5-year and a 3-year, but missed on the first 9 months of this fiscal year. And there were about 105 companies more. So 130 plus 105, about almost 235–240 companies out of a set of 500 companies. And then we looked at where there has been the maximum derating on the P compared to the 5–6 year average of that stock. And there are some interesting names popping up. And we believe that in this correction, if one is open-minded and have a slightly longer term view, this correction is providing some great franchises at decent valuation if we extend your horizon out there. So I think from that perspective, we are approaching. We are not biased by any caps. I think a lot of mid and small cap companies with great franchises, domestic facing economy sectors are looking very, very good. And there's a pivot in our view, which will happen from industrial cap goods to consumption over the next couple of years. And we need to capture that pivot as well.
Could you narrow the, parameters by which you are saying there are interesting companies?
Why don't you, I think, the same sectors, Pankaj, chemicals, and why don't you name 4–5? It'll be useful for viewers with full disclosure, So
it's not a recommendation to buy and sell, but market is telling us there's an underlying shift which has started to happen from a portfolio sectoral allocation. Look at the private sector bank and NBFC, and $13 billion of FI selling has been done in the first 45 days. Despite of that, many stocks in the private sector bank and NBFCs are in green in this mayhem. So that shows that the underlying shift has started to happen from few other sectors to banking and NBFCs, which had not performed for the last 5 years. The second is chemicals, selective out there. But I think the momentum which we are seeing in the business has started to be quite reasonably good. And don't forget that Trump has announced tariffs yesterday for Mexico, Canada, incremental 10% for China. If he doesn't do anything for India, maybe or optically he does a small number, trust me, over the next 12 to 18 months, a lot of sectors will see huge amount of opportunity emerging because China will be 20-25% more expensive in terms of tariff. So I think at that point of time, people will try to see which are the sectors, but I think chemicals can start out. Biotech, pharma can be another winner over a period of time. The third sector is metals. Normally, metals have a very high beta. But if you look at this time around in this correction, metals have surprised us because they have not corrected as much. That means market is telling us that somewhere there's a floor on metal prices. And incrementally, if you look at copper has started to move up, aluminum has started to move up. There's a slight bit of uptick on the domestic steel prices. And if there's an anti-dumping which comes through, I think probably ferrous, non-ferrous both can do well over a period of time. That's the third sector. The fourth is clearly, which we spoke about, cement. Incrementally, especially the North cement players, whoever we have interacted with, have been talking very positive in terms of both demand and pricing. And incrementally, our view is that the profitability will be much, much better than what we have seen in the first 3 quarters. And last but not, I think consumption could be a second half FY26. And that's a very large section of the market, especially the consumer discretionary names. And there are some interesting opportunities emerging where we believe that the runway to grow is next 5, 10, 15 years. And these companies are now started to be available at reasonable valuations. So these are the 5, 6 sectors which have started to look good from a bottom-up perspective. And I think now we have to dig deeper into companies and see where there's a reasonable amount of margin of safety.
Okay, all right. Thanks a lot, Pankaj, for joining in and giving us those reassuring words. For the time being, I think the big takeaway is economy is doing fairly well. There are a couple of tailwinds as well. And maybe bulk of the negative news is already in the price, at least most of it, going by what you're saying. A lot of lead indicators on ground are looking up. And the RBI action as well will hold us in good stead for the remaining part of this calendar year. Well, time to slip into a quick break. But as we do that, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or scan the QR code that's up for you on the screen.
Welcome back. You're watching us here on an early edition of Closing Bell. As you can see at the top of your screen, the longest losing streak in 29 years. Bears have tightened the grip on the market. All sectoral indices in deep red. And as we speak, a lot of stocks actually hitting lows of the day as well. We were talking about defensives trying to do better, but that's not the case with consumption names as well. Britannia is down almost 4.5% at the low point of trade. And the sell-off has actually increased on a couple of these consumer names as well. So Nestle, for instance, is at the low point of trade. We've been seeing weakness across the board in, something like Varun Beverages, which was down 7% in yesterday's session as well, down a further 3% today too. So there has been fear, but as Warren Buffett says, right, you be greedy when there is fear in the market. And we have a note coming in from Jefferies. They've made key changes to their portfolio. Hormaz joins in with the key details of these changes from greed and fear. Hormaz.
Almost everything taking a back seat with the kind of market that we are in. But Chris Wood has made some changes to his portfolio, the India portfolio being one where he is going to introduce an investment in Interglobe Aviation or Indigo, where he is going to be introducing a 4 percentage point weightage in that, and that will be financed by removing the investment in Coal India and reducing the investment in Thermax by 1 percentage point. And interestingly, Indigo and Coal India are two of the stocks that are bucking the trend in today's trading session. Now, also for the global portfolio, he's made changes to the, he's increasing his weightage in Alibaba by 1 percentage point, and that will be done by trimming the weightage in ICICI Bank. Now, for the fall that we are witnessing currently, Chris Wood has mentioned that this is due to technical factors. It is a derating of multiples and not because of an adverse macro headwind that the country is facing. Now, he also mentioned that the sell-off in mid caps and small caps is predominantly higher because of the fact that the valuation multiples there were on the higher side. He also said that the majority of the sell-off is due to the aggressive foreign selling that we have been witnessing over the last few months. And he also spoke of the India portfolio, which is concentrated in three sectors, be it real estate, infrastructure and industrials, and these three have taken a big knock so far this year. And he's compared that as well. Until December of last year, this portfolio was up around 19% in US dollar terms in comparison to the Nifty, but since then it has underperformed the index by 12% considering the fall that we have seen in all of these sectors. So an investment in Indigo, removing in Coal India, and some key takeaways for the market fall as well.
All right, Hormuz, thank you very much for that. So that's Chris Wood with view coming in through in his greed and fear portfolio. Rohit Srivastava is with us, founder and strategist at India Charts. Rohit, just down and down and down. Last time we spoke, I think we were at least a few hundred points higher, maybe 1,000 points higher, right? So it's pretty fast and furious on the downside. What's going on at the margin, and what's your view now?
So a lot of the selling, of course, has happened in stocks. Nifty has been very slow. It has fallen on 1 or 2 big days like today. Rest of the days, it has actually spent doing nothing through February, which has caused its own sense of anxiety. But when we look, below the surface at what we call as market internals, various technical indicators, sentiment, all of them just going from extreme to extreme. In fact, today, I think both a combination of short-term, medium-term, long-term data points are all coming together, telling you that the market is oversold. So clearly, the first thing it means I cannot be selling at these levels. There has to be a buying opportunity somewhere. But it does bring you back to how do you do that? When do you start acting? And you have to actually wait for a price reversal. But that's, of course, when you think of traders. Now, if you take a slightly longer term view and you think from an investment standpoint, then these readings, especially the longer term ones, are what you would look for to start being more aggressive in the market in terms of deploying money. You don't always get to these kind of levels and these kind of readings. And so it's very, very rare. And, months ago, if we thought you could actually get back to the election zone of the market where it
what kind of since the longer term indicators are the ones which are useful, give us an example or two.
Yeah, I mean the simplest thing is look at the number of stocks which is above the 200-day moving average. The number right now in live markets is at around 9% on the Strike platform that we use, and the number in 2022 when we hit 15,200 was 15%. So that means we are at a lesser reading, which means very few stocks are above the 200-day moving average, 91% are below. The only last time we had a reading like that, probably at around 5% or so, was COVID, right? So this is now the lowest reading since COVID. Even if you take a very well-known indicator like the RSI, the relative strength index, people used to gauge over bought and oversold condition in stocks. The Nifty RSI today is the lowest since COVID, and this is the first time that the domestic institutional investors have a long position. This is the highest long they have since we bottomed in March of 2023. So one by one, a lot of indicators are going off the charts. I mean, the 40-day advanced decline ratio is at the lowest since wherever it was in, I think, around COVID. So it's gone below where it was at 15,200. So all the readings are now matching COVID. Forget 15,200. And when you see something like that, you say, well, how many people remember buying at the COVID lows? And if you get the same kind of reading, why wouldn't you be buying now? Except that your mind is all washed up with sentiment based on global market or local news or something. There's no local news also. So there's actually nothing except we are now watching the globe because most of the domestic news flow is behind us.
Okay, all right. Hi, Rohit. Valid points you're making out there. But, what would give you more confidence? Currently it's one-way slide, 22,100. One would have thought, 22,000 is coming sometime during the March series. First day, bang, it's in there. So, what are the levels you're looking at in terms of support? As the point you mentioned, I think on RSI is sub 25. And I think, that's at a multi-month low, if I'm not mistaken. Multi-year low on that one as well. So, what are the levels you're looking at in terms of a support? And if we do see a bounce, at what level will you get confidence that maybe it can extend itself on the upside? Because for the time being, it appears like we're in a sell on rise market.
Yeah. So I think the downside risk right now should ideally get capped closer to 22,000. Okay, that gives you around 130 points more down from here. Potential. I'm not saying it will get there, but that's where I think mostly you will not break that right now. Looking at the setup is what I think. And if I think of, okay, above what level you would start thinking, okay, the worst is done. If I have to put an upside level, probably above 22,500. But what we are looking for, see, we are on the 8th consecutive day of decline. We saw something like that even in February, from the 5th of February all the way to 14th, we had 8 consecutive down days, and then we turned positive only for one day. And now we are down for another 8 consecutive days. We call that time equality. So somewhere in terms of time, if we do even turn positive on Monday, I would start believing that maybe the bottom is in. And with this downside risk of 22,000, I would consider that as an initial indication of things turning positive. And then we look for it actually crossing 22,500, looking at our momentum indicators to give a buy signal and so on.
All right. 22,000, 130 points. I think after a big decline, the street would take that as a bottom, telling you that, okay, 130 points is a bet that one, who's looking at an upside from current levels would not be very worried about from here itself. Let's talk about individual stocks. If the markets were to move higher to levels beyond 22,500 and thereafter, if you're looking at momentum indicators there, what would the stocks, according to you, be the ones that would lead that run?
So I can't name specific stocks, but I'll tell you the sectors that are holding out, and that is how we study it. Like if I just take the decline from the 5th of February to the 28th of February, so we do a heat map test, which is essentially looking at what is the relative performance during this fall, what has held out best. And the top two are metals and financials, right? So metals and financials, I think, will top the list in terms of where you want to be. They are holding out even in the fall, not falling much. Maybe some are, but most of them on average are not really falling much. In fact, the bank nifty has not even made a new low since January, which itself tells you where it stands. So I think those are the two sectors within which I would find the key ideas initially. But I do think later on, as things pick up, you will find other opportunities in some of the most beaten down.
Rohit, banking and what's the other sector?
Metals.
Metals, banking. Yeah, please go ahead.
So other areas which are beaten down where I would really look is going to be PSU stocks, because if again I look at, say, a slightly higher time frame, I look at the weekly RSI of PSU stocks, they are back to sub 30. Okay, and the last time that happened was in the last bear market. So you're sort of, getting to very oversold readings even in some of the sector indices, like I said, PSUs, maybe even PSU banks. So that entire PSU basket is getting very, very oversold. And these are all areas which are not extremely overvalued, like the whole fear which has been around mid caps. These are the segments where you really find value. So that's where I think you'll find the opportunity initially.
No, got that. By the way, Rohit, so you track global markets, etc., also closely, and that's the other point which many have been talking about. That is a top in for US markets. If that is in and there is a meaningful pullback, what will that mean? Will that put more pressure here? Will that add to the pressure, or will it relieve some pressure? What's your sense?
So if we do get a meaningful top in the US market, the answer would be an obvious yes. And there are basically two macro factors that we look at to derive the answer to that question, which is essentially what are bond yields doing and what is the dollar doing. Now, if you ask me more than a month back and have been on air, we are probably looking at, a long duration bearish phase in the market, and we were hoping that, it'll stay that way. You'll get bear market rallies along the way, which is sort of what has happened, but the bear market rallies have been very small. But now, because the dollar started to roll over a bit, and more significantly, bond yields started to decline sharply, and clearly that is what the US is working towards. In all of these deals that you're hearing behind the scenes, the idea is that they get their costs down, expenses down, and eventually get yields to go down, so they can at least keep their domestic spending, but not cut down on the external side. Now, what all that means is that if you're getting interest rates down, that could actually be a positive trigger. Has that worked in some places? So you're actually seeing outperformance in Europe, right? European markets last week also were making all-time highs. They only corrected a bit and they're bouncing back today. They're not falling as much as the US anymore. You're not seeing that in China also. You're only seeing it in some markets which are more volatile in Asia. Most of the emerging markets, maybe Japan, and specifically, of course, India is reacting to anything. We are not even reacting to the upside in the US when it happens. So very different situation. So the world markets, when they are so divergent, see, if this was a global sell-off, then you would have seen Europe also, falling off a cliff along with the US, which is not happening. So I'm reading the idea that you'll get a weaker dollar, or at least weaker yields will eventually drive a weaker dollar, as being positive for emerging markets. And that is why I started to think maybe after a 5-month decline or 4-month decline, we could be at the end of something. And it may be a little early to say that this is going to become a global turmoil.
Okay, so not a top in that sense in the US as well then, and lower yields, lower dollar is broadly how you're thinking about those two variables as well. And those, generally, as you said, have been positive for EMs. Rohit, we'll leave it there for now, but interesting conversation, and we could have gone on, and we will continue this chat later. Thank you very much for being here on CNBC TV18. We'll take a break. Deepan Mehta on the other side. So as I said, lots of views we'll get to you over the next hour as well. I think we just passed the 230 mark, are we? 240 now. So yeah, 22,130 or so is where the Nifty is at, 420 points lower. Deepan on the other side.
Welcome back. For the time being, 22,100 has held out, and the big boy, the big boy HDFC Bank, that's rock solid. It reminds me of the Indian team in the late 1990s when you used to go overseas to play cricket. There used to be Sachin's wicket was most important, and Sachin is holding its wicket as of now. I think, if I have to, I'm looking for Azhar as well, because at that point of time, when you used to go to South Africa, in particular Mangalam, if you remember, Sachin and Azhar.
Azhar would be your generation, Nigel. Sachin, Dravid, and Sehwag Ganguly sort of generation. But be that as it may, I get your sentiment. Reliance is holding up. Azhar is, if you must. Holding up mildly in
you remember
green.
Kapil?
Kapil is
because we have Coal India, we have Shriram Finance as well as HDFC Bank. They are the few stocks that are up 1.5 to 2%. It's that sort of a market where you need to cheer some of these boys on. But Ashish Kyal joins in. Ashish, well, we've seen a bit of a bounce from the lows. The Nifty Bank as well come off close to 200 points. Not asking you which generation you're of with regard to the cricketing parlance that we were referring to. But tell us, how are you feeling about the markets? What are the levels you're looking at? And fill us in with a couple of trading picks.
Absolutely. I'm also from the same generation, Nigel. How Dravid, Azhar and Tendulkar played. So that was altogether a different cricket. And the best was the India-Pakistan match at those point of time. So having said that, if you look at the markets, there is, for me, there is no bounce back. If you look at the past 16 days of daily chart, not a single close has happened on Nifty above the prior candle high, above the prior day high. That's the simplest way to follow the trend. And these 16 days, I think it's a record. I have not seen it post 2020 COVID, where Nifty has not closed above the prior day high for a running 16 days. On the weekly chart, it has been, I think, running 19 days, nearly running 8 or 9 weeks when we have not managed to protect the prior week low. It has been breaking the lows. It has been managing to close above the high, but again breaking the low. So it has been 9 consecutive weeks. If we look at this entire downtrend which has started, I think this is one of the deepest correction that we have seen post-COVID 2020. And if I take a Fibonacci retracement from the lows of the COVID till the top, the 23.6% retracement comes to around 21,800 odd levels. So that's the first support zone. 21,800 is what I'm seeing. If that is breached, then the next 50% comes to around 21,300 levels. And that's a very important level also, because if you see the election lows were formed around 21,287 and the election top was around, is already broken right now. So the event low and the top are very, very crucial. So I think the bottom has to form. It has to form around the zone of 21,287 to 21,700, 800. That's the zone where one should start nibbling on to all the good stocks. And the easiest way to identify those good stocks are the ones that has not fallen or contributed much on the ongoing downside. So if you look at a few names that I have to take, something like a Bajaj Finance, something like a Shriram Finance, something like HDFC Bank, to be honest, that you were talking about. So those are the stocks that has not contributed towards the fall. And that shows a very strong relative outperformance, which means when the market stabilizes, these will emerge as the ongoing leader. So over the short term, index remains on the sell side, but we are oversold right on the daily time frame, right on the hourly. On the 15 minutes on the hourly, we are quoting around, I think, 15, 16 on the RSI, which has been extremely oversold. So short-term pullbacks are possible, but use that pullback to sell, maybe for the target of 21,800 on the downside over near term. And for me to turn bullish, it has to give a close above prior day high. Very simple.
You mentioned a few of those stocks. Stick to the higher name, better quality names if you'd like. I think you mentioned a couple of financial as well as banking names. You want to give us individual stock calls?
Yes, from the individual stock calls, one on the buy side is going to be on Bajaj Finance, which I have talked about already. Even over short term, I think the stock is outperforming. Yesterday, it gave a bullish breakout. Today, there is some pressure, but I think it should head towards the level of around 9,000 on the upside, 9,000, 9,200. It is possibly it's one of the third wave on the upside as per Elliott wave. And so it's going to be good move that we are expecting. On the downside, the support for the stock comes to around 8,380. That's the first one. And the next one is on the buy side is Interglobe Aviation. We can clearly see an outperformance, possibly forming a triangle in the fourth wave pattern. And if it manages to break that 4,600, we can expect it to run towards 5,100 in the form of fifth wave. So 5,100 is the target for Interglobe. And on the downside, the support for the stock is going to be around 4,300 levels.
All right, we take that point, Ashish. Thank you so much for joining in. Meanwhile, a bunch of stocks which are actually now finding some buyers. So keep an eye out on something like a Trent, which has seen a big cut of almost 42% from the peak. Currently has moved to the, moved into the green off lows. So Trent has moved higher. You have Hindalco as well. We were talking about how a couple of these metal names are, favorable for a lot of the experts who came on the show earlier as well. So Hindalco is the one which has now moved into the green. Then you have JSW Energy. That has recovered a good 5% from lows. Currently sitting with a gain of 1.5%, but that's a strong outperformance that we've seen in light of the weakness that we've seen in the broader markets. APL Apollo Tubes is the other one which is moving higher as well.
Manappuram Finance, that 20 DMA is very, very important. There's a buzz about that deal. Manappuram went to that 20 DMA and seen a bit of a bounce. So maybe a bit of a technical play out there. That's the stock up for you on the screen.
All right, we look at Manappuram and a bunch of other stocks which are seeing some sort of bottom fishing, if you must. If not, then a bounce from oversold levels itself. The key lead indicator of the month of February or how economy is doing will be how auto sales would come by as well. We have the weekend, March 1, March 2. We'll have a bunch of them reporting their sales, monthly sales number. Sudarshan joins in with the key expectations. Sudarshan, are there any signs of improvement from auto sales?
It's very unlikely. We are expecting a weak print for the month of February. But before I talk about wholesales, if you look at the retail sales, February has turned out to be the weakest in last few years. If you exclude the month of September 2024, which has seen the adjustment due to festival data. Now, all the major segments are going to see a decline in double digits, with passenger vehicles seeing a fall of 14%, two-wheelers 12%, and MNHCVs have seen a decline of 11% in the retail registrations. Now, on the wholesales, estimates are saying that most probably print is going to be weak. Now, as per Nomura estimates, PV wholesales in February expected to rise 2% year-on-year, while two-wheeler industry wholesales are likely to see a fall of 6%, and MNHCV wholesales may see a fall of 8%. And one segment that might do better is the tractor, and for this industry may see a jump of 11% in the February. Now, talking about the company specific, Bajaj Auto sales are going to see an increase of 4% in the two-wheeler sector. Except Hero Moto, all the companies are going to see an increase in the wholesales, with Bajaj Auto may see a jump of 4%, TVS 6%, and Royal Enfield may see a jump of 15%, while Hero Moto wholesales may see a fall of 6%. In the four-wheeler space, especially passenger vehicles and commercial vehicles, Maruti and M&M Auto may outperform, with Maruti may see a jump of 4% and M&M Auto 12%, while for Tata Motors, it might see a fall of 4%, and for Ashok Leyland, it might be a flat or may see a minor increase of 1%. One sector that I talked about may outperform with the tractor, and following that trend, M&M tractor sales may see a jump of 12%. So apart from tractor, all the segments might report a muted wholesales for the month of February, and this is what even retail sales data are indicating.
Right, Sudarshan, thanks a lot for that. So we were asking you whether there would be any sort of recovery likely, and Sudarshan's one-word answer was seems unlikely. Though keep an eye on a couple of these stocks. We have V-Mart Retail, which is recovering from the lows. About 6% is the recovery that we've seen on V-Mart Retail from the lows. Arvind is the other one. This is the Arvind Textile Company that we're talking about, Arvind Limited, and not Arvind Fashions. Arvind Limited is another one which is seeing a gain of almost 4%. Street believes that maybe better export opportunities for some of these textile players. And then we have some up move that we're seeing in this recent listing. It's Eco Lighting. It's up around 12% from lows, sitting with a gain of 9% and volumes piling up on that stock as well. So a few, stray stocks making big moves, trying to make an attempt from the lower levels itself. Let's welcome Deepan Mehta on the show right now. Deepan, there is a fair amount of pessimism, and a lot of them are bordering towards saying that, okay, this may perhaps be the time to bottom fish, look for opportunities which may make you good money over the next 18 to 24 months. What is your thought in this correction? Is there anything that has swum into your framework of value, growth, and good company at a good price?
Good afternoon, Mangalam, and thank you for having me on your show. Just a quick study which we did about the overall P multiple of the entire market. And at this point of time, the P multiple of the market is equal to what the P multiple was there in October 2023 when this entire bull market, this phase of the bull market started, and the Nifty went up by 38%. So from a valuation perspective, we are back to where we started. And that gives us a lot of comfort that we're getting into a good zone where if you buy for the long term, 3-5 years or so, you will be able to get very good returns from this point of time. And again, I think the focus has to be in small mid-cap stocks only where there is still growth, and growth can certainly revive because of steps taken by the government and the budget per se, and even the RBI. So we are getting confident by the day that these are good levels to buy. Look, nobody can predict the bottom. Nifty sensex overall market can drift even further lower from these levels. But now at least valuation concerns are gradually being addressed, and a lot of stocks are getting into a decent price earnings growth multiple.
Deepan, you're talking about mid caps and small caps. Finally, it's been a while since you turned cautious early, and you were kind of hammering on the point that there's just kind of gone crazy. But of course, I mean, the turn has also been very swift, as somebody was pointing out, perhaps one of the swiftest turns without a global catastrophe that we've seen in 45, 60 days or so. So the damage has been quite intense. So that's the hunting ground in that sense, Deepan. You don't believe, like many do, that the next few months is large caps and maybe mid caps and small caps still have a long way to go?
No, Prashant, we want to go for multi-bagger stocks, and these are the times if you buy, then you hopefully get a multi-bagger stock 4-5 years down the line. And if you keep chasing large cap stocks and trying to go for safe stocks, then you're going to miss this opportunity. And unfortunately, in India, what we're observing is that a lot of large cap stocks, the growth has just evaporated. I mean, look at FMCG, look at large cap tech, look at banks, look at automobiles. I think a lot of large industries, the growth rates have come down to just at or below the nominal GDP growth rate, which is 10%. And if you want to get that, target, which is there of doubling your money in 4 years, then you need to go for businesses which can grow 15-17%. And I don't think any large cap Nifty stock, sensex stock qualifies for that 15-17% type of top line growth consistently for the next 3 to 5 years. So by that TINA option, there is no alternative. You have to look for small mid cap stocks where there's good corporate governance, very strong business models, good competitive moats, and can still grow at 15% plus type of top line, 20-24% type of bottom line growth, and reasonable valuations.
Okay, you want to name a couple of them, Deepan?
Sorry, I didn't get the question.
Deepan, since you're sounding so optimistic after a long while, you're saying it, here's the time has come, here's the chance. If you want multi-baggers, you need to pick them in these sort of markets, because you're getting a lot of good stocks at depressed valuations. Could you name a couple of them?
Okay, now again, we get into that zone, where compliances, disclosures come into place. Let me give you an overview. See, consumption is going to look up certainly over the next few quarters. We like a lot of specialty retail companies like Ethos, Go Fashion, Metro Brands, Vedant. All these companies have been completely going sideways to declining. Campus Activewear for last several quarters or so. But if retail consumption spending picks up, especially on the urban side, these companies are now at reasonable valuations and very good growth runways. We like a lot of these solar and wind equipment manufacturers, the likes of Vari Energies, Premier, Suzlon, Inox Wind. Great earnings visibility and I think reasonable valuations after a very long time. And then, of course, the platform companies, which have been our favorites, like Zomato, Zaggle Prepaid, RateGain Technologies, Affle India, India Mart. So these are the kind of stocks and sectors that we are looking for in terms of increasing our exposure over time. And there could be many winners within the kind of these three industry groups which I spoke about. And but investors should do their own due diligence. These are just kind of suggestions. And as a matter of disclosure, we may be investing in a few of these stocks as well.
Okay, Deepan, thanks a lot for giving us some of those ideas. You're sounding optimistic. You're on the prowl. Good to hear, Deepan. It's the most optimistic I've heard you in a while. Quite a few stocks from the footwear space, some of the renewable energy stocks as well. Have a good evening, Deepan, and a good weekend ahead as well. Well, if you want to pick up one positive, we had around 190 stocks that were advancing when we started off the show. At least that number has gone to around 290 now. So some kind of pickup in terms of the broader markets from extremely depressed levels. Pramod Gubi, who's the co-founder at Masterless, joins us on the show. Hi, Pramod. Good afternoon and good to see you, Ben. We'll have Pramod with us in just a bit. Do we have him? Okay. Okay, all right. I think I'll tell you what. Let's slip into a short break. You come back. Pramod Gubi will be with us, and we'll also take stock of the market that's showing some signs of a recovery. Stay with us.
Well, the street is looking at some opportunities, ideas, or maybe some sort of recovery from the lows itself. Pull up something like Hyundai Motors. That stock has now moved 5%, and that's a big recovery of nearly 10% from the lows on that stock itself. And this 1 day ahead of their monthly sales number details, that stock surged. From the broader markets, we have Dixon Tech, which is holding out in the green. Voltas continues to do well. So Voltas has moved off lows, currently at the high point of trade for that stock as well. And then a couple of these banking names. We have Bandhan Bank, which has recovered from the lows as well, currently at the high point. And in the large cap bank space, we've been speaking about how HDFC has held one end of the banking index, by its sheer weight and doing well. We have IndusInd Bank, that too has recovered a goodish bit from the lows, still in the red, but has cut its losses to about 3.5% after seeing a big cut in the earlier part of today's trading session. So good time to get in D-Street chatter. Nimesh joins in with an insight into dealing room. Nimesh, there has been a fair amount of capitulation in the market. What are the tidbits that you've gathered from dealing rooms?
Before I talk about the markets, just a word on a couple of stocks that you highlighted, the likes of Hyundai, the likes of IndusInd Bank. They've recovered sharply intraday only because of the MSCI flow. Hyundai is getting added to the MSCI, and hence you're seeing a big reversal in that stock. Similar is the case with IndusInd Bank as well. So a lot of these stocks will see a reaction in the last 30 minutes because of the MSCI rebalancing. And that would mean that the institutional flow may look very large today. That's because of the $1.4 billion of inflow, only because of the MSCI. So that's something one needs to take into account. But except MSCI, the feedback is that there is buying interest in financial names now. And for a change, after a long time, some bit of buying seems to be back in the large private bank names. So that's a bit of a change in terms of stance as well from an institutional activity point of view, that there is buying now in the financial names. But the flip side is there is massive correction in the broader market names, kind of a carnage there, and there is a lot of pessimism now from retail HNI investors. So clearly that's one leg which is showing some signs of capitulation, and people are like throwing in the towel. But so even there, surprisingly, Mangalam, the feedback was that today some buying has happened from some large HNIs and some large investors into some select stocks. So again, today's fall to a small extent has been used to nibble by some influential names. That's the overall feedback from a flow perspective. The other challenge is the technical levels. What we used to talk about, that 20 to 800 is a very big support. Now that will turn out to be a very big resistance on the upside. So you might see a bit of a pullback. We have to watch out for the GDP data today. That can give us a bit of a booster on Monday morning. But now I guess it will be sell and rise rally, and 20 to 800 will now act as a very big resistance, which erstwhile was a very big technical support on the Nifty.
Okay, all right, got that, Nimesh. What about individual stocks, though? Fill us in with some of those names.
Well, so in terms of individual names, the first stock is Granules. That stock is massively under pressure today, down 7%. In fact, the stock is relatively underperformed in the last few weeks. But interestingly, from a flow perspective, a couple of domestic institutions have been aggressive buyers since the US FDA clampdown came on that company. And interestingly, one of the domestic large fund is likely to cross the holding by 5% in Laurus very soon. So that's the first name, which is Laurus. The second, Granules India. The second stock is Varun Beverages. Even that stock has seen a massive correction from the highs. We've seen a one-way down. Now at these levels, some bit of nibbling is happening. First signs of buying interest from large institutions in Varun at these levels. So that's the second name. The third stock is Embassy REIT. Again, normally don't talk too much about this stock. There was large volumes yesterday as well. I guess it was a clean out trade from a long-only fund. That fund is completely sold out now. And now some bit of buying is back in Embassy REIT as well. So that's the third name. And the last is Macrotech Developers. Again, after a massive correction in all the real estate names, some signs of buying interest is back. And interestingly, Macrotech stands out in terms of buying flows from large institutions today. So, in a weak market, I guess today there is some signs of buying interest or nibbling happening, both from institutions as well as HNI investors.
All right. Good to hear that. Nimesh, thank you very much for that. So we take that feedback, talk to you again in a bit at 3:30 on Editors Roundtable. We'll take a quick commercial break here. Markets are down 400 plus again, so that 70-point bounce is all but gone. And I think we're back at least on the Nifty at the day's lowest point. We'll come back and get you some technical trading ideas, short-term trading ideas. Stay tuned.
Welcome back. You're tuned into Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets are still a little bit subdued, but take a look at individual names. Some of them are off to the races. Alchem Laboratories, pull up the intraday chart of that stock. That's moved to the high point of the day. So good move is what we're seeing out there. India Cements as well. Remember, the deal got done with Ultratech at much higher prices, 380 or thereabouts. But India Cements as well has seen a sharp spike up. Persistent, the stock was down 6%. Now it's down 2.5%. So it's cut its losses. And the other one is Dixon as well. So the advanced decline ratio actually should come up. It may not look materially different, but actually from around 190 stocks that were advancing at the start of the show, at least you have 340 names now that are in the green. Ashish Kyal is back with us. Ashish, a bit of a bounce on select stocks. Give us a couple of trading picks.
Yes, Nigel, if you look at, I think, Home First Finance, that has shown a very sharp recovery today, huge volumes. It has gone up by nearly 8%. And as we speak, it is now 9.5% up, already from at around above 1,000 levels. So it looks like there is going to be a positive target of 1,100 on Home First Finance that we can expect. On the downside, one can maintain a stop loss of around 955 and use any dips to buy. That's the first stock on the buy side. And the next stock is on the sell side is Piramal Enterprise. We can see it is breaking below the multi-week low and the stock is closing at that levels. So Piramal Enterprise looks to be weak. I think it can move toward the level of around 800 on the downside. One can maintain a stop loss of 900 levels on the upside.
Right, Ashish, thanks a lot for that. Even as we're seeing some recovery in a lot of individual stocks, the Nifty is down once again at the lower end of today's trading range, closing in on that 22,120 mark. It's at the low of today's trading session, and that's led lower by Reliance. We look at Reliance, the intraday chart comes up for you. It was holding mildly in the green, supporting the index, but there you have it. It's down about 1.5% from the highs at the low point for that big boy, currently pressurizing the Nifty. The other one is Infosys. Now, the IT stocks have all been underperformers, severe underperformers. Today, the IT index is down about 4%, and now it's seeing incremental selling. The Infosys stock currently at the low point of trade as well. And from the broader markets, Bata, a stock that exited F&O yesterday, is now a cash market stock, has seen a swift decline, currently lower by 65 rupees, and most of the cuts have happened in the last 15 minutes or so itself.
I just want to, if you can, just one thing we've not mentioned is look at how Asia closed earlier, right? Actually, they were very large cuts. I think if you can just quickly put up, Europe is already trading, and we'll look that up as well. But Japan was down 3. Kospi, I think it was the largest single-day fall. You got to go back to 2024, August of 2024 to find a fall like that, and many other markets. That's Europe for you, which is not exactly down as sharply. But Asia, it was like across the board between 2 and 3.5% cuts that we had earlier. And just one more thing, if you think about it, which is the one space which has really gotten hit this week, or actually even today, it's the IT services space. The IT index is down 4%. And, till 2 weeks back, if you just sorted the sectors which have seen the maximum damage, IT was hit the least. But it's caught up. Very quickly it's caught up. And I think I have the numbers here. The IT index is now down in line with the rest of the market. It's down 19% from its respective all-time high, the Nifty IT index. It was around about 8% 2 weeks back. The right at the top of the list, of course, is real estate, which is down 31%. IT is at about 20, but so there's still that difference. But it was lesser impacted. But and of course, this week we've seen acceleration in cuts. So the biggest losses this week are all tech names. Tech Mahindra is down 10% this week. Wipro is down 9%. TCS is down 8%. HCL Tech is down 7%. And Infosys is down about 7% as well. So just wanted to make that quick mention. Mangalam.
All right, let's welcome Jay Bala then from cashthechaos.com. Market expert Himang Jani joins in as well. Jay, coming to you first, at what point does it stop? That's the bigger question. Everyone's waiting for 22,000, 21,800 to 22,000 is the support. Do you think it's a good time to start nibbling into the indices right now and some stocks at these levels with slightly deeper stops, or maybe wait for a confirmation of an up move and then buy a little higher?
That's right, Mangalam. Good to be here. I would do the latter, and that's always the better strategy. You wait for the market to tell you that it's bottoming out, and once it's done that and given you a reversal signature, that's the better strategy to get inside the market. Until that point, you stay in cash, do nothing. I'm not a great fan of SIP, and I would rather be outside the market and regret it, rather be in the market and regret. I wished I was outside the market. So the indications are right now still the momentum is pretty strong to the downside. Yeah, oversold, but in a bull market shouldn't get oversold. It stays above oversold levels. So getting oversold is a sign of market weakness. Unlike what others say, if it's in a bull phase, the markets don't get oversold. So this is a warning sign, and we have, like Prashant pointed out just a few seconds ago, IT index, which was up, holding up just 5% with a 5% decline. That's come under tremendous pressure. And we had pointed out repeatedly on CNBC that if it were to break 39,900, it'll come under intense pressure. And that's what has happened. So wait for the market to say that it's bottoming. Until that point, do nothing.
All right, Jay, don't hurt me. I'm keeping my SIPs going, and I'm having a lot of faith out there. That's fine. We could have different views on that front. But, the other factor that you had also mentioned is on the small cap space, right? You said maybe we drift a little bit lower, but it appears we're bracing for a bigger move on the upside, at least in the near term. That's still on because the small cap index is the one that's taking it on the chin, on the nose, it's getting hammered.
That's right, Nigel. The February 18th low was an important low, and I said if it were to exceed it by 42 points, then I had to do a slightly bearish revision. But the next support comes at about 14,100. But the idea that small cap stocks are likely to see a fierce bounce in the short term, that will give an opportunity to exit, that doesn't change. So, it would be an opportunity to exit. But I still see somewhere about 16,800, 17,000 once the reversal sets in. I know we had the bounce that we saw from the February 18th low just got just a 3.5% bounce. And it's so fleeting. Probably the next one is likely to be little more sustainable, because by the time I anticipate the large cap also to have come to a significant support either at 21,800 or 21,200.
So 14,100, if it holds out, you're not ruling out a level of around 16,800 to 17,000. Is that correct? Which will be a good selling opportunity, correct?
Yeah, spot on. You nailed it, Nigel.
No, you nailed it. I'm just reconfirming it, Jay. Tell us, what about individual calls? You want to give us two stocks?
It's a bit late to sell or go buy, because it's be against the market. But you might want to look at stocks that have been doing pretty well as possible selling candidates. Look at Interglobe, which it's been doing quite well, and it's been staying up. Usually when markets start to drop, the winners get sold to compensate for the losing candidates. So wait for the 2-day low to break on Interglobe. If that were to break, keep a stop loss at about 47.40 and anticipate Interglobe to give a corrective decline.
That's very interesting, because a lot of people are bullish on Interglobe, and you're saying that, okay, if the markets have to fall, maybe some of the winners will fall as well. So 2-day low on Interglobe is something we'll keep an eye out on. But, it's the mood of the market. When we were talking about a couple of stocks seeing an up move, and Nimesh was talking about that impact of the flows coming in as well, right? IndusInd Bank, it recovered from the lows, the flows impact came in, and then from there itself, there was a slam dunk. And that's not the only one. Currently at the low point of trade for IndusInd Bank, down about 7%, when it had recovered at the cut of 3.5%. Hyundai is the other one, which saw a big up move from the lows. It was up around 6-7% from the lows, went into the green, went higher. And just as swift was the rise because of the MSCI flows, equally swift was the decline as well, now down about 6.5% from the highs itself. So we are seeing, the mood of the market is definitely that on the sell side, as against, seeing some bottom fishing. Any sort of recovery is being sold into a lot vehemently and with a lot more gusto as well. Let's bring in Hemang Jani. Hemang, any idea which seems appealing to you right now in wake of such capitulation in the market?
Sentiment is definitely quite weak, and people are sort of capitulating. But I don't think that when you look at the markets, there are certain stocks which are holding out well. So I think you guys discussed about Interglobe. So when I look at the numbers, fundamentals, the fact that the crude is low, the fact that you have 2 more airports which are going to open up, And it has outperformed the market in the last 6 months to 12 months. So I do think that this is be one stock that I would have a high conviction on. You can have more stocks on the mid cap side. I was surprised by the way Ultratech sold off yesterday. The kind of news which was there and relating that the market cap loss was too much. So I don't think that it would be good to kind of look out for opportunities and get into some sort of a buying mind frame, though it's very difficult to actually implement. But given the way the market is selling off, we are somewhere near that capitulation phase to my mind.
Okay, and just a quick word, you're positive on Ultratech, Interglobe, BSE, you want to give us a word on that?
So, Nigel, BSE has been a darling of many investors, has done very well. And when you look at both the equity and derivative volume, from all-time high, it's down 42%. Now, some optimists say that the premium turnover on the option is relatively, it has fallen less. But, this has been a theme which had a lot of over-ownership. So maybe I think some people are trying to get out because you don't know how long this low volume phase will continue, both on the derivative and cash segment. So maybe it's going through a bit of a correction. We should wait out for more signals to emerge in terms of volume revival. Try to buy into it.
Got it. Okay, all right. Hold on. Let's slip into a short break. Come back, continue to focus on markets, and we'll wind down the markets for you as well.
Welcome back. You're watching us here on Closing Bell as we are counting down to what has been a very weak session for the bulls and a very weak week itself and a weak month. Something that hasn't happened in the last 29 years. Let's wind the trades down with last thoughts from Jai Bala and Hemang Jani as well. Hemang, in this decline, you said sentiment is extremely weak. There are a couple of stocks which are bucking that trend. Cements, for instance, cables and wires. There was that big announcement that came in yesterday on the back of which there was a sharp sell-off that we saw in names like KEI Industries and, Polycab and Havells too. But now these stocks seem to be finding their mojo back. They've recovered a bit. KEI Industries, for instance, is ending the day at the high point. It's up 4.5%. Do you think the sell-off has, largely priced in the disruption?
Definitely, Mandam, there was a case of overreaction. See, these are not very small companies. So Polycab is about 75,000 market cap company. And this quarter, put EPS of 45, full year about 137,000 order books. While there is a case of disruption over a period of time, for next, let's say, couple of years, 3 years, the companies would deliver good solid growth. So I think that 18, 20, 25% kind of a reaction on a large cap companies clearly is a case of overreaction. So I would definitely use this as a buying opportunity. The only thing is that because there is a concentrated holding by some maybe funds, PMS houses, AIFs, and they have to kind of reject their portfolio, the impact could be very high, which is what is visible right now.
Right, gentlemen, thank you so much for your time today, and we'll start beginning to wind down today's trading session. What was, like I said, a weak one for the bulls, and something that reminds the markets that, the bear is still well and truly active. We have the Nifty down about 430 points in today's trading session. Sensex and Nifty ending 2% lower. It's not only the last day of this month and this week, but also the first day of the March series itself. So the Nifty this week after today's cut is down about 3% for the frontline index. The Nifty Bank, which has been a relative outperformer, ended the day lower with 1%, but for this week down by about 1.5%. What was selling off very strongly today were the broader markets. We have the mid-cap index and the small-cap indices, both of them down anywhere between 5 to 6% for this week, down 2.5 to 3% in today's trading session itself. And with this move, both these indices are firmly in bear territory, down 21 and 25% respectively from their all-time highs. What was down? Actually everything. We had nearly 2,300 stocks in the red for just about 400 stocks in the green. The IT index was the key culprit on the downside, down about 4% odd. Among the few stocks which were higher in today's trading session, financials really stood out. We had HDFC Bank, which was an outperformer. Shriram Finance was a top Nifty gainer. Coal India as well did well. And from the broader markets, some recovery in the names of like KEI Industries, Bandhan Bank, and towards the last hour, we saw some pullback in names like India Cements as well. But gainers far and few in between, and we saw a fair amount of losses in today's trading session, marking history on the wrong side for bulls. Bears making history after 29 years, where 5 successive monthly losses is what we've seen for the frontline index. With that, we wrap up on this edition of Closing Bell, but you stay tuned to CNBC-TV18, our Friday special Editors Roundtable on the other side.